Welcome, everybody, and thank you for joining us today. We are very excited to be discussing real estate investing with you. My name is Sara Stiles, and I'm a certified financial planner at Rise Consultants. Rise offers tax, accounting, retirement plans, and financial planning services to both businesses and individuals. I've been in the financial services business since 2003, and I have an undergraduate degree in corporate financial management and a graduate degree in personal financial planning. And I've been wanting to do an educational event on real estate for quite some time, and it's because it's one of the most commonly asked questions that I get from plan participants when I'm sitting in the 401k conference room or when I'm sitting down with some of my high net worth clients. They have a lot of questions about how to get involved in real estate. So while I know how real estate fits into a financial plan, I am not an expert on things like the status of the real estate market or financing and what it entails to be a real estate investor on that side of the fence. So that's why I've invited my friends Vinny and Kim to join me today. Say hello, guys.
Hi, everyone.
How you doing out there?
Kim, let's start with you. Can you tell us a little bit about yourself?
Yeah, of course. Thanks for having me here today, guys. A little bit of a background on me. So I've worked in management, sales, and marketing for close to 20 years. I have a master's degree in criminology, and I started law school, but I realized quickly into it that I was meant for sales because I love working with people. And after realizing law school wasn't for me, I moved to Kansas City in 2017, and I started working part-time with Vinny in 2017, auditing contracts, and we became a team full-time in January of 2019. Since then, we've hired 2 transaction coordinators to assist with our volume. We're growing, and it's been exciting.
Absolutely. Thank you very much, guys. I tell you, I definitely don't have all the fancy degrees that they have over there, but I love being surrounded by these.
You're smart enough to hang out with us.
That's right. He's very intelligent, so that's great. A little bit about me. I moved to Kansas City in 2007. I was managing Sprint wireless stores. Actually began with them in 06, started as a sales associate, worked my way up to a store manager and district manager, covered about up to 10 stores and 60 employees, and all was great, but then decided that real estate was the direction I wanted to go. I was with Sprint for about 9 years, but I started my real estate career in January of 2015. Ran my business initially as an individual agent for the first few years. Like Kim said, she came on, 2017 part-time and was fortunate enough to bring her on full-time and began our team, Vinny's Realty Group, with Keller Williams Platinum Partners. That was early last year. Since then, we've been able to take home several awards for both monthly and yearly production, and very proud. Last year was our first full year as a team, and we combined for about 68 units with just over 10 million in production. So we're seeing a lot of good growth and love to see that continue. And thank you very much, Sarah, for having us here. Let's get started.
My pleasure. Okay, so today we are just going to have a conversation about common questions that each of us are asked, and I'll be addressing whether or not real estate as an investment is a good financial planning strategy, and then Vinny and Kim will be sharing about what real estate entails. Okay.
Absolutely. So, Sarah, we've talked about this quite a few times over the last, couple of years. Let's kind of just start right at the basics. Is real estate a good investment idea?
Well, good question. So I would be remiss if I did not acknowledge how crazy the last few weeks and quarter have been. Up until the COVID-19 situation, the stock market was thriving, the jobs market and other economic indicators were all looking great. We were at historical highs in the stock market with the longest bull run ever. So the situation that we're in today just goes to show how quickly things can change. And on one hand, I'm feeling a little opportunistic because I have 30 plus years until I'm going to retire. So if I'm a stock market investor right now, I have the opportunity to buy into the market cheap or at a discount. Mm-hmm. On the other hand, I'm self-employed. And so if my business struggles because the economy is struggling, I have no other source of income if I don't have customers. So for me, that's kind of where I'm at with my investment situation and why I would be kind of thinking maybe there's something else I need to be doing here. Okay. If someone's nearing retirement or already drawing income from their investments to supplement Social Security, situations like this that we're in today could really have irrevocable consequences to their overall financial status because they're trying to withdraw from their assets while their assets are down, 20, 30, 40%. So all that to say, times like this are a perfect example that we're living in today of why it makes sense to diversify your assets, diversify your sources of income, and real estate is a great option to do that.
Yeah, definitely. It's definitely some uncharted territory we're all dealing with right now. So, Sarah, why don't you elaborate a little bit more on using real estate to diversify your assets and sources of income?
Sure. So first and foremost, real estate rental income can be an excellent way to give you steady cash flow above and beyond your employment income or your retirement income. So we all know it's a rental income, you can supplement your income. In addition to providing an income stream, though, real estate's a tangible asset, which appreciates in value. So you have opportunities not only to get income off of it and supplement your day-to-day living, but you also are increasing your overall net worth and increasing your asset portfolio.
Mm-hmm.
So, and then real estate, the other thing that makes it really nice is it's a tax efficient investment. It's a very tax efficient way to invest. And we'll dive a little deeper into that later. But the income, the increase in wealth, and then to be able to do those things in such a tax efficient way, those are the reasons why I think real estate really makes sense.
Okay. So, obviously we can expect rental income. It's dependent on what the mortgage rates or mortgage and going rates for renters are, but what kind of growth rates?
Sure. So I'm glad you asked that because it gives me an opportunity to address a really important point.
I know you like graphs, so.
Oh yeah, financial people like financial nerds, we love our graphs. So let me look here. Okay, but growth rates are really solid with rentals and real estate over the long term. So it could be a very lucrative investment from a growth perspective. But when it comes to investments, real estate, just like any other investment, with reward comes risk. I've been asked by people if it's better just to get out of the stock market and put all my money in real estate. And my answer to that is absolutely not. Please do not do that. First of all, real estate is not a liquid asset. So if an individual has a catastrophic medical issue or some kind of a financial crisis and they need immediate cash, if all their assets are tied up in real estate, they're at the mercy of the current state of the real estate market and whether or not someone wants to buy their property to be able to get the cash that they may need. The other thing is that real estate is very volatile. So my chart that I love here, Vinny, what we're seeing here is that real estate is more volatile than the stock market. This chart compares the total return performances. So total return refers to the growth of the investment and the income generated from the investment. So the total return performances of the S&P, which are in the blue. And for those of you who don't know what the S&P 500 is, it's basically the measuring stick of the overall stock market. So that gives us an idea about how most stocks would have performed during this time period. So from 2014 till today, as you can see, comparing the blue, which is the stock market, to the red, which is the housing sector, an investor would have made over 20% more by being invested in real estate. But look at the volatility that real estate had. I mean, it was a much bumpier ride for the real estate investor versus the stock market investor. So all that to say, real estate is a great idea for many reasons, but it shouldn't be the only egg in your basket, and there are certain risks, involved with it. So in light of what we've just seen about the historical growth rates of real estate and volatility of it, can you kind of speak to what the status is currently of the real estate market? Is it a good time?
Kim, yeah, can you go over the next slide?
Yeah, absolutely. So knowing your numbers is extremely important. And if you're looking at this chart, you can see that inventory for the last month was down about 20.9% in comparison to February of 2019. A lot of you might wonder what this means, right? So this basically shows us that for the most part, that it's a seller's market since there aren't a lot of homes available. There's a benefit though in today's market for buyers since borrowing money is cheap with interest rates being so low. So good properties that are priced right are going quickly. So you can also see that the average sales price on this chart for the past February in the Kansas City area was $238,062, and that around 2,270 homes were sold. And knowing the market and staying up to date with your numbers, it's very important when looking into investing. And also, if you look on this chart, you'll see that there's only 1.8 months supply on the market. What this means is that if there are no other properties that were going to be listed, we'd run out of inventory in less than 2 months. So it definitely shows that inventory is very low.
Thank you very much for that information, Kim. And I tell you what, it's kind of like you mentioned, good properties that are priced right are going quickly, and that for investors, that's, if you're flipping houses or anything like that, that's a great thing. Now, at the same time, with everything that's going on right now, it's you got a lot of investors who are kind of, they're wondering, we're getting a lot of calls right now. How's this going to affect things? How's it going to affect the market?
So I'm not the only one getting those calls?
No, not at all. Not at all. Now, the one thing that I would say is, the most importantly, is the demand is still there. I mean, the inventory is down so much from 10 years ago, from what I've studied and read, there was a lot more properties on the market. There's a lot more not good loans out there, and that's not the case right now. So you could definitely have to be cautious, but folks are definitely out there still buying and selling. So Sarah, we've moving on from those things, we've talked quite a bit about different strategies, as far as planning ideas and stuff when it comes to real estate investing. The one common question I know we both heard is how is real estate rental income taxed?
So this is obviously a top question that I get. If people feel like they want to get into real estate because they're trying to make money, and then they want to know what kind of tax consequences they can expect from that. So rental income is taxed at ordinary income tax rates. And what that means is it's taxed just the same as your paycheck from employment. So if you're in a 28% tax bracket on your paycheck, then you can expect that would be how your rental income would be taxed. Unless you're a self-employed individual, in which case the beauty of real estate income is that it does avoid self-employment tax. So that's a nice way to kind of be self-employed but not have to pay that self-employment tax. Now, you do have to be careful because rental income could very well push you up into a higher tax bracket.
Okay. So that means you're doing well, but you got to plan for that.
No money, no problems.
There we go. So, well, okay. So how can a real estate investor reduce some of those taxes on their real estate income?
Well, you have access to deductions just like you would with your employment income. So you can deduct things like your mortgage expenses, maintenance expenses, taxes, and insurance against the income you receive. So you're really taxed on your net income from the rental property, so to speak. You also get a special deduction with real estate called a depreciation expense. And depreciation is basically calculated by dividing the purchase price, or what your CPA would call your basis, in the property. And for residential properties, that's divided up over 27.5 years, or it would be divided up over 35 years for commercial properties. Another deduction that you may be able to receive if you qualify for it is a qualified business income deduction. And if you're under certain income thresholds, which are around $300,000 a year, if you make less than that, you could deduct up to another 20% from your rental income that you receive.
Okay, a lot of good information here. Let's talk about, what about when you're ready to sell a property? Is that tax different? How does that look?
It is different. So similar to a stock or a bond or any other type of investment that you might hold, you will be subject to a long-term or a short-term capital gain. So if you sell the property within the first 12 months, you're subject to a short-term capital gain. And those are taxed at your ordinary income tax rate, just like the rental income would be. If you hold the asset or the house or the property for longer than 12 months, then you would realize what's called a long-term capital gain. And long-term capital gains are taxed or capped out at about 20%. You'd have about 5% state and about 15% federal that you would have a cap on those long-term capital gains. If you use the proceeds of the sale of your property to purchase another property of equal or greater value, you can defer taxation through a nice rule called a 1031 exchange. So that's a nice way to avoid or to delay or kick that tax bill down the road, if you will, on the gains that you receive from your property. One thing to note too, when selling a property, you just got a depreciation expense year over year. When you turn around and sell it, there is something called a recapture rule. And that would pertain to, quote, or somewhat giving back some of the depreciation that you had received on the property that you actually didn't realize because you sold the property before theoretically 27.5 years, if that makes sense. I won't get too far into the weeds on that, but it's just something that you need to be aware of when you're selling a property, that could be a consideration.
Okay, so as an investor, I've seen it before. Folks buy property and then just sell it, and they don't really have any I've heard of the 1031 exchange before, but is that something your company knows about and helps with? Or?
Absolutely. Yeah.
Okay.
Absolutely. We have on-staff CPAs who are experts in the tax code, and this is something that we work with regularly. So we definitely know how to help people do those types of transactions and make sure that they're making the most of the situation.
Okay. Well, do me a favor, because I know a lot of us are visual people. So
Yeah, I'm a visual
that's
person.
Vinny's over there doodling.
Absolutely. So I know you mentioned you had some real life examples to give a little bit of context on how it looks.
Yeah, so I thought we could walk through a real life example of how this could look for someone. So say I purchase a residential rental property or investment property for $150,000. Say this property brings in $21,000 a year of rental income for me, but I do have to spend $10,000 a year on maintenance, mortgage, taxes, insurance. So it actually takes my net rental income down from $21,000 a year to $11,000 a year of rental income that I'm actually going to pocket. Then I get to apply an annual depreciation allowance, and that is my $150,000 that I paid for the house, or what we would call on the CPA side of things your basis in the property. So I get to take that $150,000 and I get to divide that up over 27.5 years because this is a residential property. So that amounts to $5,454 per year that I get to deduct from my pocketed rental income. So I don't have to pay taxes on that amount. And then if I'm under certain income thresholds, and right now it's around $300,000 a year. So if I make less than $300,000 a year, I would qualify for what we call the QBI, or qualified business income deduction, that I could take against the remaining taxable income. So if I had $11,000 of pocketed income, I took away $5,454 from that in depreciation. That leaves me with about $5,546 that I can take that 20% against, which would amount to $1,109 for my QBI deduction. And basically what all this is saying is that I was able to pocket $11,000 of income from this rental property, but after my depreciation and my QBI deduction, I was really only taxed on $4,437. So this really demonstrates how, what I was talking about earlier, how real estate as an investment can be a really tax efficient way for you to grow your wealth and to get income.
That's important. Don't do your own taxes if you're doing investment properties.
Please don't do your own
taxes. Call
taxes.
Sarah or her people.
You don't do your own taxes anyways, because we love to help. Like, we enjoy helping you get money in your pocket from the IRS, all of us.
Very good.
Okay, so we've covered, it's a good idea. It makes financial planning sense. The time is right. And we walked through a tax planning example. So why don't we chat a little bit about how to get started in real estate? So Vinny and Kim, can you help us understand what it takes to get involved in real estate investing, and what are our options if we want to get involved?
So there are different ways to type different investment types. One of them is your purchase of a primary residence. So a lot of people, they don't take into consideration that when you buy your own personal property, it's an investment. So this is why when making a decision on purchasing a property, that you have some guidance with that. There's also a lot that you can do with your equity when you have it, which we'll cover here shortly. But just keep in mind, just because you bought a house doesn't mean that you just have equity automatically.
Oh, I see. Yes.
Yeah.
Really? All right.
Okay, you have to hold it for a little while to get equity paid on your mortgage.
We've all been thinking on that.
Yeah.
There's also rental properties. There are single family and multifamily properties. There are many different types of rental variations. There's long-term rentals and short-term rentals. Short-term rentals are things like maybe like Airbnb, VRBO, things like that. You can also do buy and flip. I'm sure a lot of you are familiar with HGTV.
We're all flippers.
Yeah.
Chip and Joanna.
Yeah, you don't want to see me try to hammer down a wall, that's for sure. But it definitely appears a lot easier on TV than it is in real life. And basically what this is, guys, is when an investor buys a property, renovates the property, and then sells it for a profit. There's also wholesale properties. And this is when you find a property for a lower price and then you sell it to another investor or homeowner for a profit. Typically little to no work done on the property.
Is that like if you maybe get a repo?
Yeah.
It's in good condition or something like that.
Sort of. Maybe, maybe there's somebody, even in the job market today, right? Or in the market today, somebody may have unfortunately lost their job They need to get out of their house, and maybe they owe $80,000 on it. Their house is worth $120,000. They're willing to sell it for $100 just so they don't have to.
Because they can't sustain a mortgage.
Yeah.
Okay.
So
They're typically distressed properties. So
Yeah.
a lot of those are typically off-market sales, but very, very, very common and lucrative way of investing. So very popular.
absolutely. And of course, we've got commercial properties, and this can be something like an office building, retail space, industrial space, etc. And Sarah, you mentioned that you have some clients that own some commercial space. What does that look like?
Yeah, quite a few of my clients, Rise really has a niche in working with business owners, and quite a few of my clients are professional services. They do professional services, or they're in the medical profession. So they will own the office space that they operate in, and then they will lease out office space to other professionals. So those people are basically paying their mortgage for them, and then they get to operate in that space for free. Business within a business.
It sounds like a business hack. We'll talk about a house
I
hack
love
after a little bit.
hacks.
So
I love my
good.
hacks. But yeah, it's a really smart way for a business owner to operate in their space and then do it in a tax efficient way. I actually have another example, just taking that a step further, that I like sharing, that kind of is thinking outside of the box. But I had a client who was about 45 years old, and she had accumulated through conversions and just savings about $500,000 in a Roth IRA. And for those of you who don't know, IRA is an individual retirement account, and Roth means that the money inside of that vehicle grows tax-free. It means the person who put the money in there paid taxes on it when it went in, and then provided they hold that asset until retirement, it grows inside of that retirement vehicle tax-free. So my client was able to purchase her office space where she was working and operating into her Roth IRA. And she bought her $350,000 property. She's now receiving tax-free income from the people that are renting space from her. She has free space that she's working in and operating in, so that reduces her overhead for running her business. And she has an asset inside of a Roth IRA. She's getting tax-free rental income and tax-free growth on the asset. So I think that's just a really neat idea, something outside of the box, and a really smart way to leverage a real estate investment inside of your retirement plan.
Wow.
And this is how people make money on their money. Right?
Yeah. So that was a bit more of a kind of a complex situation. I like to call that like my legs showing situation. It's a little sexier idea. Vinny, why don't you go over an example that may be more relatable to someone who isn't a business owner?
Oh, absolutely. That's really what I like about this kind of call and working with you on things, because, you've got a lot of business owners working with commercial deals, and, we work with a lot of folks who are dealing with their residential portfolio or just figuring out how to get started.
Right. And a real estate investor has to know both sides of the fence. And so you have perspective, I don't, and I have different perspectives. So it's been fun to kind of marry our perspectives to round out advice that we can offer our clients.
Absolutely.
So you were going to talk.
Yeah. So this example here, it's really hits home to a lot of folks that I work with and know. But so we got a married couple in their 30s. They've owned a townhouse here locally for about 10 years. They actually bought it at a tough time, right after the market, right before the market crashed in 08. But yeah, they did. Ooh. So it went in the gutter for quite a while, but they stayed there, which was nice. So
did you hear that, investors? Even though things go down, if you stay there, they go.
Now it's worth.
Tell us how it went up, Vinny. Let's hear more.
That's right. It's went up considerably from when they bought it, although it did go way down.
Just give it to the Texas.
We will. There we go. So on that property, they've owned it for about 10 years, and they were wanting to get into rentals. They knew that they wanted to keep that as a rental. Okay. So initially they were looking for a single family home, but they came across a duplex. Actually, not far from there in the same neighborhood. They ended up purchasing the duplex, and they were living in one side. Okay, so that's the cool thing about it. If it would have just been an investment, they didn't have the 25% at that time. But since they were living in that as a primary residence, they were able to only put 5% down.
Like an FHA mortgage?
Just conventional, standard conventional financing, because it was a primary residence. So they purchased the duplex, did a little bit of renovations in it, and moved into one side. They were rented out the other side, as well as the townhouse.
Now they have two rentals and one they're living in.
Correct. So it's 3 units, I guess, but one of they're living in.
Occupying. Okay.
And then 2 others rented. And the two that were rented covered the mortgages on both properties.
Oh,
So it actually was I think it was about $2,100 in mortgages and $2,200 in rental amount.
so basically the renters were paying their mortgage while they lived in the town.
Absolutely. Yep. And then if they did decide they were continuing to pay their mortgage, but they were just paying it right down on principal. So they were just
So they weren't pretending they didn't have a mortgage.
Correct.
They
we're just going on vacation all the time. They're paying it down. Now, probably a year after that, they actually ended up buying a single family home and moved into that. And at that point, they were able to rent out all 3 units now. So when you factor in the townhouse, the duplex, and the single family home, all 3 properties, the mortgages totaled about $3,500. But when they're able to rent out all 3 of those units, both sides of the duplex and the townhouse, those were $1,100 each, so totaling $3,300 a month in rental income for a grand total of $3,500 in mortgages. So it essentially almost even paid for those mortgages and their house
that they live in.
That's right. And then lastly, all the duplex and the townhouse, just really within the last couple of years after they purchased that, the appreciation is in the $50,000 to $60,000 range on this property.
So basically owning 3 properties. Right? And it's $200 a month out of pocket expense for them to do so. And then they've accumulated $55,000 in net worth over a 2-year time frame.
And these are, and they purchased in areas that are absolutely appreciating.
Were these people rich?
So, hey, no, I wouldn't say that. Not at all. Not at all. Like I said, they couldn't do the 20% down. They could stretch the 5%
so
down.
I think this example, though, is really relatable and could resonate with a lot of people. And it just kind of demonstrates how the average person really can do this if you're smart with it. And it, like what Dave Ramsey says, you live like no one else today, so you can live like no one else tomorrow.
That's right. That's what we're working on.
Yes. Okay, so why don't we move into some of the best practices before buying for those who are kind of ready to get started? What do they need to know before they get involved in that?
Absolutely. And really, I've been fortunate enough in my real estate business that early on, I connected with some real estate investors. Some were very knowledgeable already, and others were just kind of getting their feet wet as well. So we learned a lot of great things of what to do and what not to do. Okay, so a few best practices that I tell folks who ask about getting into real estate. First of all, you got to learn what a good deal is. You know, it's kind of a broad and general statement, I guess, but that's really what it's about. You know where you're wanting to do business, familiarizing yourself with the geographical areas and the values of those neighborhoods. And basically you find a property, you know the price, you factor in, you know, your cost to renovate or repair or anything like that. And then what will that property be valued at afterward? You know, they call that the ARV or after repair value. You know, if you buy a property at this amount, put this much into it and sell it for this, you do that math ahead of time. And if you have the data to back it, that could be a good deal. Or on the rental side, if you're putting that into it and then it's going to get you the rent rates, that's going to make sense for the return on your investment there. Second part, as far as best practices, you know, learning what features enhance rental and resale value for that specific property and neighborhood. Okay, and I tell you what, when you're renovating a property, you have to be aware of what you're spending. You know, it's always, you know, you don't want to overbuild for the area, for your market. Okay, everybody always wants the granite and the nice fixtures and all that, but I'll tell you, it's much more important to offer a good quality product than you know, just overdoing it.
Yeah.
Now,
and I think about it from a consumer's perspective. When I'm shopping for houses, if I go into, if I see a house online that has granite countertops and all this, that, and the other on it, and I go look at it and it's in a shanty neighborhood, I'm not going to buy it. I don't care how nice it is on the inside. I want the location to be good. If I want high-end fixtures, I want a high-end location.
oh, absolutely.
On the flip side of that, if I'm in a nice neighborhood and I go into a property that looks like they cut a lot of corners and there's chintzy work done in there, it ain't gonna go either. So yeah, I think that's a really great point, that you have to be aware of the area that you're building in and making sure that the extra expenses that you're putting into it merit the location.
Absolutely, and you make a good point. You know, you don't want to cut corners, you know, but it's, you know, again, you have to know your area, because in a lot of, depending on your price point or where you're at, let's say you're in a price point that's targeted to first-time home buyers or a growing family, those are normally financed deals. They're not, so they still have to appraise. They still have to, so you want to make sure you know
But you
your
have to
market.
know where to allocate your budget on more higher end things and where you're going to be able to do it versus.
Absolutely. And again, that's also where we provide a lot of value to our clients. One of the things that we get asked are what does this property look like, and how, what do the values do? What should I do to it? Okay.
Well, that leads me into my next question, because you're saying learn what a good deal is, familiarize yourself with the area, know when to cut corners. Or you don't really cut corners, but you're saying you're careful not to say cut corners because you don't want people doing
Sure.
that. But we kind of know. How do I do that? If I'm a complete novice and I know nothing about real estate, where do I learn these things? Am I Googling it? I don't know. Like, who tells you those things?
Well, great point. I guess I was really kind of just leading into that is, building a network of knowledgeable experts. Okay. And this really comes down to building relationships. Okay. When you're starting into this or you're wanting to grow it, there are a ton of avenues of knowledge out there, from books, podcasts, networking groups, social media groups. All those things provide a ton of value. Now, at the same time, at some point, you're going to make these connections, and you got to strengthen these relationships with the folks that you're in business with. From your trusted contractors, like you said, to your trusted financial person, to inspectors,
Lenders,
real estate agents, lenders,
with the people financing your deals.
Yeah, all those things. There's always risk involved, but you want to do as much as you can to strengthen that offer of investment that you're doing.
So real estates, they can do more than just stick signs in people's yards and then stalk you on Facebook and post pictures of houses on Facebook.
You said we stalk people on Facebook, Sarah.
Well, not as a company, of course. No one has ever been stalked by a real estate agent.
Tell us how you really feel, Sarah. I tell you what, it's working with investors early on has really taught me what it takes some work to build trust with. I mean, for us as a realtor to expand our own knowledge, to confidently be able to advise an investor, but it takes time and work to build that trust and that relationship.
And Vinny and I work by referral too, so we want to create a great experience for our clients. So I want to do business.
And I think that's the point I was really trying to make is, I think a lot of people assume realtors are meant to get people to look at your house and get traffic into there, but there's so much more value that they can learn from your expertise if you're the type of realtor that's interested in leaning in and providing that value.
No, absolutely.
Then you could really use them as a valuable resource.
We would agree, Sarah.
Okay. On that note, I think we should get into what kind of cash is involved and what kind of cash outlay someone would need to get started in real estate, and what are their options when it comes to finance.
Kim, they say all the time, you need like 20, 25, 30% down to invest. Is that right?
Oh, I love when people come to me with that question. It's one of my favorites.
Or with that money.
It's not true. And although it is nice if you have a ton of cash to put down on a property, there are different ways to finance one as well. So having said that, these are the different types of loans. There's different financing options between primary residence and owner-occupied versus investment loans. One of those is like a conventional loan. So this one is used most common. It's used both in primary and investment loans. Rates and down payments do vary depending on owner occupant versus investment property. So typically, if you're an investor and you're doing a conventional loan, you'll need a higher down payment on this type of financing, and that usually is about 20% down.
So that would be in one case where that would be required.
Yeah. So now this also talks about, like, like they say, a house hack. That person who wants to start investing but finds a multi-unit property, a duplex, a fourplex, anything like that. So they're able to, do they have to have 20, 25% down as well, or?
No, they don't. So that's what's nice. So let's say, for instance, even the scenario you brought up earlier, and it was an owner-occupant loan. So you had a duplex, and they lived on one side, and they were able to get an owner-occupant rate, which those rates are generally lower as well. In addition, a 5% down payment rather than 20% down. And renting one side of the property, living in the other, and then moved, but still is able to maintain that rate, and that doesn't have to put any more money down. So
absolutely,
it definitely pays off to know people that know what they're talking about.
Right.
You can save a lot of money and cut corners, so to speak, right?
Yeah. Like some professionals get into their little niche and that's their lane they like to stay in. So they don't expand their knowledge to be able to think outside of the box. And
Stay in your lane, bro.
yeah,
Oh, nice.
I'm with you on that.
Yeah. So another example is HELOC. This is a home equity line of credit. This is a tool that many people use once they have built enough equity in their primary residence or their investment properties. So basically, you're borrowing money against the equity in your home at a low interest rate.
And I find in my practice, I don't think a lot of people realize that you can use a home equity loan for something more than debt consolidation or finishing your basement. You actually can use your equity in your home to purchase another home.
Yeah, absolutely. Invest it into other investments.
You can use it to go to the casino, Sarah.
Vinny, do not say this to me. If, like my husband and I go because he likes to, and I about have a nervous breakdown in there. And then when I see like someone in there that asks me about debt counseling, and they're in there at the tie-out table, they don't. No,
I'm too
Vinny,
frugal to
don't
hang
do
out
that.
with them.
Because my blood pressure just went up. So Kim, you were saying?
Sarah's over here breaking a sweat.
Yeah.
Just kidding. So there's also hard money loans. Generally, this is an interest-only type of loan. It's usually issued by private investors or companies. And in order to qualify for this type of loan, you usually have to have some sort of assets. And this could include an open line of credit on a credit card. Usually those are around $10,000 or more, maybe another house or some sort of asset. And lastly, we've got 203K loans. They're also known as renovation loans. And these are loans that finance repairs into the total loan amount where renovations have to be completed by licensed contractors. So just because you know how to fix something and you maybe know how to, hang up drywall, or maybe you know how to put in counters, if you're not licensed, then this loan probably isn't going to work best for you. If you're not licensed.
So say I bought, like, is that an example? Like if I bought a property that is a repo and someone trashed it, but we know that under normal circumstances, it would be worth twice as much or a third higher, whatever. I could go in and they could say, well, in a normal situation without this property being trashed, it would be worth this much. So we'll loan you this much, even though you're only paying less to give you the cash you need to fix it.
Yeah, and
Is that basically what it is?
There's different ways of financing it, and every scenario is a little different, right? Because if you have a lot of money to put down, maybe a conventional is going to work out best for you. Or maybe if you're only going to own it for 3 months or 6 months, maybe a hard money loan where you're paying interest only is going to make most sense to you. People that don't have a lot of cash up front, but they want to have a home that's maybe been foreclosed on, maybe a renovation loan is good for them. A 203K, FHA, they don't require a lot down. And there's just so many great options for so many people out there. And I think that as we educate each other and, as we're all learning in this together, we can really be beneficial to.
Well, and clearly you guys are not lenders, so you know a ton about loans and able to bring that value to your clients by working with good lenders.
We know who to connect them with.
Yeah,
we're not the lenders.
Yeah. But it shows though that in your knowledge of the lending and all that.
You know who to connect them with, Vinny.
What's that?
He said you know who to connect them with, Vinny.
Oh, I know who that was.
They had to be heard.
What's up, Bobby?
I thought he was muted.
I know.
I'm just joking. You're the man.
You, Bobby. You're always able, Bobby. Okay, so I would like to kind of just share an example of how one of my clients used a home equity line of credit to put her kid through college.
Awesome. I love these stories.
Yes. And this was such a neat experience for me because it solved a lot of problems for her and we were able to do something really, I don't know, I just love the creativity of it and how it solved a lot of problems.
It changes people's lives too.
Yeah. So I was working with a single mom and she had some equity in her current house. She had been raising 2 kids and they were getting to college age. So she had equity in her current home, but not enough to take out a line of credit and write tuition checks and pay for dormitories every year. So what she decided to do is buy a small property just off campus where her son was going to go to school. And they offered to allow his friends to rent from her. So if you think about, if you stayed in a dormitory and you know what your college experience would have been, that you were sleeping on a metal bunk bed in a cinder block room, right? And a parent is going to write $8,000 to $10,000 worth of checks a year for room and board. This this mom was able to provide a 3-bedroom house where they bunk beds or whatever. They could have 6, 7 guys in there that, you know, are all renting very cheaply. So the parents could pay, you know, my client rent, and then they were getting a good deal, basically. But the rent that she was collecting from her son's friends was enough to pay down her mortgage. So she didn't have a mortgage payment. They were paying that. And she still had enough cash left over to write checks for tuition. And guess what is tax deductible expense? Education, tuition.
Nice.
Yeah. So it was a very tax efficient way, and for her to put her kids through college basically and give them room and board without having to give up her employment income to do so. And then the neat thing is, you know, she had 2 kids. One went to college for 4 years and the other one was on the 2-year dropout plan. So she had the property for between 4 to 6 years. And when her kids were done with college, she sold it. And she, instead of taking the gain on it and taking cash out, she did a 1031 exchange into a nice little vacation home for herself. So she was able to basically put her kids through college in a very tax efficient way without having to use her retirement assets, without having to use her employment income and derail her own personal financial plan. And then she was also able to reward herself later in life with a nice little lake house.
And the kids didn't have a couple $100,000 in student loan debt?
No, and if I could go back in a time machine and in my parents' year, I would probably tell them about the story, right? Maybe we
Feel you.
with a plan here. Yes, yes. Okay, so let's talk about where credit factors in, because this mom had decent credit, but what if I'm someone who might have a little shaky credit? You know, what's required here to be able to do something like what we're talking about?
No, great question. Obviously we deal with credit is a big thing. Cash, credit, debt to income, all those things are we dealing with our clients quite frequently. Great credit and a lot of cash is always a big plus, but it's not required to invest in real estate. Okay, so obviously your typical loan that you're anticipating to receive, you know, does factor in credit. Your conventional, your renovation loans, even the home equity line of credit. Those things are do have credit factors on that. But one of the nice things that Kim had touched on before, the hard money loans, they don't emphasize credit near as much. You know, their main thing there is it a good deal? Okay, they look at the numbers, they want to see the purchase cost, renovation cost, holding costs, and if the numbers make sense, then you can usually get financed for that with little to no money down. You do have to have some sort of assets, you know, a certain amount of cash or a line of credit or credit card, something for that. But yeah, hard money loans definitely gives you that option. If you've ever heard on TV, you know, get into real estate without using your own money or no credit, I mean, it's very possible. It's not.
When I see those commercials, I think it's like Better Call Saul.
Hey, it's one of those things. It's simple, not easy.
Yeah, so it is true.
But you have to know what you're looking at. You have to know where to find the deal.
Okay. All right. Why don't we get into the ongoing management and maintenance of rental properties? So, common question that I get from my clients is, how much work is involved with this? Because if I have a full-time job and I want to do this to supplement my income, is this going to rule my life?
No, great question, because you know, and that's I like how you put that. What's after you buy? What's next after you buy? Because there's several things to plan for. So starting with rental properties, you know, first and foremost, the property management. You know, is this something you're going to self-manage yourself or hire a professional property management company? And there's a lot of factors into it. How many units are there? Are those properties close to where you live, close to where you stay, or are they all spread out across town? You know, are they even in a different city or state? You know, we have a lot of out-of-state investors that love to invest in Kansas City. They love our folks out on the West Coast and East Coast, love our prices right here. So we have a lot of out-of-state investors. But obviously, if you hire a professional property management company, they typically get on a standard rental about 10% of the rental income is their fee.
Is that tax deductible? I'll have to ask my CPA partners.
I was going to say, let me ask you that.
It sounds like an expense to me. Sounds like a business expense.
Absolutely. And they're the main point of contact. You know, they screen renters, they take the calls, they collect rents, handle the contracts and leases, really oversee all the aspects, you know, of the rental property. Self-management, you're the one handling those things. So when something goes wrong middle of the night or on your weekend or out of town or whatever, that call's coming to you.
So the answer to that is then, if you're willing to shave off a little bit of your revenue, then it could be very low maintenance investment property.
Sure.
Or you can handle it yourself.
Well, and as long as it's part of your budget as well, right?
Well, and something I tell people, ask me this quite often, and I always say, it depends on what are you passionate about? What do you want to spend your time doing? This is, for myself, I currently have a few units and I self-manage them. They're close by me. Now, this is also my industry. This is what I kind of live and breathe every day. Other folks, they're out, killing it in their job. Do they want to be, do they have the time to be responding to things during the day?
It's a capacity.
So it's kind of the risk reward and what are your goals? What's your interest?
What if I decide to flip houses?
Let's see here. Yeah, different. A lot of things to plan for in flipping houses. Now it is different, obviously. One of the first and foremost things are your renovation costs. Okay, before you've bought the property, you should already know your scope of work and your budget and all those things. But keeping to it is what's difficult. Okay, things pop up, and as we mentioned before, you don't want to overbill. Okay, stick with your plan, your budget, and you may have to tweak and redirect here and there, but always keep in mind knowing your numbers. Okay. Budget for unexpected costs, unexpected expenses. I don't know. I don't think I have a flipping client that's had a project that went through the whole thing without having some surprise costs pop up.
Yes, which also raises the point that you should have a good inspector.
Yeah.
There you go. Shameless plug, Bobby.
Good inspector. There you go. Good inspector, good contractor.
I appreciate that. Thank you.
You're welcome.
You'll join us on the next call. So knowing your numbers and providing a cushion for yourself for some of that unexpected expense. Okay. Holding costs. Okay. If you're looking to renovate and flip a property, how long is this going to take you? Okay. What's your estimate for you? Because not only is it the cost to purchase and renovate, but you've got your property insurance, taxes, utilities, interest, all those things that are due every month. Okay, so we got to factor that into your bottom line when all this is said and done. And then lastly, if you're flipping a property, your ultimate goal is to sell this for a profit. So what are your costs to market and sell this property? When I work with my investor clients, when we're starting the process when they're looking for homes, it starts with them sending us an address, me or Kim. What are the comps like here? How much can this go for? And so we're looking at what they purchase it for, all their costs, and then before they even make the offer, we're running an estimated net proceeds to say, hey, that's showing conservatively we might even be able to stretch it here, but conservatively we should be able to sell it for this price.
Good deal, not a good deal.
That's right. And factoring in all of the marketing costs and fees that come along with the sale, as long as those numbers all work, factoring in all these things, that'll let you know if this is a good deal.
Okay, well, we've covered a lot of information today, so we're going to kind of wrap things up here. But just to reiterate the points that we started with, is real estate a good idea? Does it make sense? Yes, it absolutely makes sense as a wealth building investment. It's a wealth building investment. It can provide supplemental income, and it can do both of those things in a very tax efficient way for people. However, it's volatile, and it's something where, just like any other investment you approach, it should not be the only egg in the basket. So just making sure that we're disclosing that. The time is right. You've talked to us about the status of the real estate market and give a lot of great points as to why now is a great time to be jumping into this. We've gone over options on how you can get involved in real estate investing, and then talked about some resources that you have. There's many resources that you can have to gain an entry point into the space, and then also to outsource a lot of the work and to leverage strategic partnerships to help you get it done in a more efficient way.
Absolutely. And one comment I that it's kind of hung on with me with real estate is, it's always the right time to buy or sell the right real estate. It's kind of when the different tools out there, it comes down to being able to see a good deal and then seeing what tools out there.
It is a good point, because even though we show a chart, we talk about how volatile the real estate market was. I definitely had clients in the 2008, 9, 2007, during that time period, the last recession that we saw, that were actively buying properties, and that they were still making money on real estate. I wouldn't say at that time the market pullback was for different reasons. And so a lot of that was centered around lending and things like that. But I was definitely still seeing, even through that time period, people were still doing it. So to your point, if you really know what you're doing and you have the right people helping you, then you can still do it in any environment.
Sure, absolutely.
Okay, so before we let you go, if you get nothing else out of this whole discussion, we just hope that you will see that it's really important to align yourself with the right professionals and that who are knowledgeable and in their field, that have a good network that they can share with you. You know, Kim.
Yeah. So thank you guys for being here, for listening to us. You know, we really appreciate it. I just want to close out by saying, you know, it is very imperative that you keep up with the market. If this is something that you're looking into doing, you need to know your numbers. Having a good real estate expert is crucial to succeeding in your real estate investments. As an active real estate agent, I come across and work with a lot of great referral partners, such as contractors, inspectors, plumbers, lenders, etc. But I'd be happy to share those with you if you ever need a referral. I'm in this business, Vinny and I, Sarah too, but we work with so many great people on a day-to-day basis. And, you know, these are people that I trust, that I know would work well for you as well. So just guys, wrapping this up, know your budget, know the market, and know the best places to find a good deal so we can help you make some money, because at the end of the day, it's a business and it's all about the Benjamins, baby.
Exactly. On my side of things, just make sure that you're working with financial experts who, you know, make sure that your CPAs and your accountants really understand the investments that you're holding, and they know how to tell you all the best ways to make the most of that asset. A financial planner, I mean, we help with things like legacy planning and what to do with all these properties that you might have in your portfolio when you're gone. You know, how do you incorporate them into your estate plan, and helping you manage your cash flow as you're acquiring properties and as you're funding projects and all the things that you're doing with them. So make sure you also have a good team of good financial experts who understand real estate as an asset and as an investment, and can help you make the most of your investment.
Absolutely.
Okay, so we thank you for taking the time to join us today. We're going to be following up this presentation with the recording, so you will have a playback link if there was something in here that you wanted to kind of revisit, or you want to share this with someone. Here's our contact information. We would really love to hear from you if you had questions on anything that we didn't address, or
just more
access to our network, or whatever we could do to help you.
Or more details on certain things. So yeah, we're all, and if we don't know the answer, we know someone who does.
Right,
so.
right. But thank you so much, guys, and we appreciate your time today.
Thank you, guys.
Stay safe.
Thanks, guys. Good job.
Stay away from cooties.